Okay, so welcome once again to Financial Accounting by Coach Samuel Ibanda. We are here basically to look at the statement of changes in equity, and we're just trying to look at the format which we have here, and then we shall be able to do the question that relates to this. Okay, so the examiner sometimes wants to set this as more of a single question in its own, or sometimes they can just ask you just a very small knowledge about it. Okay, but what you have to know when it comes to statement of changes in equity, for it, it's more looking at the equity items of the balance sheet. Now, when they speak of equity, we know very well that the key aspect of equity is, let's say, capital. Okay, but for corporate organizations, this capital could even go beyond to become share capital, and could also cascade through to have share premium in it. Now, when they say share premium, what they are trying to basically mean that these are shares that were sold at a value that is higher than their normal market price, basically normal price. So, for example, if a share is 200, just like the way MTN shares were at 200 and they were sold at, let's say, 250, then the 50 difference is basically share premium. So it will also have a separate account for it. And then also we could have also now other elements of equity like reserves. Now, what are reserves? Reserves, this is usually money set aside to cater for specific let's say specific aspects of the business. It could be, for example, the business wants to buy a fixed asset, the business wants to expand, so they put some money in the reserve. Okay, yeah. And then, of course, the most common one, which is the retained earnings. Now, retained earnings, these are basically accumulated profits from previous years. We know very well that businesses make profit, and they may choose to distribute it as dividends among the shareholders, or they may also choose to retain this within the company, and at the end of the day, maybe later use this for other kind of purposes later on. Okay. Now, a statement of changes in equity keeps on varying based on the company at hand. So if a company does not have a reserve, it will not have a reserve column in its statement of changes in equity. If a company has a revaluation, maybe a revaluation surplus, it will have that a column respective, because revaluation is also part of equity. Okay, revaluation is also part of equity. And what revaluation, the revaluation surplus account, what it basically records, it just comes in place when we revalue our assets. Now, when our assets revalued, assets are revalued when their market value is way higher than the carrying amounts that we have in our books of accounts. Okay, because their carrying amounts result from the depreciation. So we keep on depreciating our assets, but when businesses make a valuation and compare the carrying amounts, basically the net book values, vis-a-vis what is actually in the market, and they realize that the assets are way valued lower compared to what is their value is in the marketplace, they come and revalue them. So that amount of money that they revalue them, of course, we debit the asset and credit the revaluation surplus. So the revaluation surplus is an element of that falls under equity. Okay, so if in case we have it, we also have a column for it as well. Okay, so those are basically the most common ones: the retained earnings, the reserves, the equity itself. This equity can also have a share premium, okay, or they can call it share capital as well. And then the revaluation surplus that I've talked about. Yeah, basically that is what we may basically have. And like I said, every organization would have, if at all you look at the question and the question does not have any reserves, then you leave that out. Okay. Yeah, so that is very important to know that. So this is our question here. Okay, this is our question. Of course, it starts from here. where it is telling us that in Uganda's education system, graduates have two career options after completing studies. They either choose entrepreneurship or salaried employment. Explain why a person should choose entrepreneurship over a salaried job. Those are 5 marks. So you're able to, now for this one, you may not even have read about it, but all you know are the importances of entrepreneurship over jobs, okay? Of course, with entrepreneurship, you like a boss of your own. And you also, of course, the return to entrepreneurship, you're able to, let's say, have a more structured time according to your preference compared to employment. Entrepreneurship is also more rewarding. Usually the profits are not capped like salaries. Somebody can be able to earn even beyond somebody who is in employment. At the end of the day, entrepreneurship also gives you a room for innovation, okay? Because it doesn't have a fixed job description. It's more open, okay? And then entrepreneurship would also basically also, of course, can also give you more time as well. So you can look at different aspects in terms of return, in terms of time, in terms of the grant for innovation, in terms of also for security. Yeah, entrepreneurs usually own the jobs. So they have a high sense of security compared to people who are employed. So those different reasons, somebody can be able to choose and say, I'm going to take this line, okay? So such questions may not really require you to really have exact, like, let's say, very similar answers. The way you think about it may be totally different, okay? But at least as long as you're able to give what best suits the kind of question, and as well as also being able to give examples where possible, okay? Yeah. So the other part of the question was asking us about authorized share capital and issued share capital. Authorized share capital and issued share capital, okay? Now, when they say basically authorized share capital, okay, this is basically means the number of shares that a company can issue as stated by its memorandum of association, okay? A memorandum or articles of association. It's basically, you would call it, because it's authorized, it's basically the legal, it's the legally accepted maximum number of shares that a company is allowed to issue based on its corporate charter, basically, okay? That is what basically includes. Now, when it comes to issued, it's more of now how many shares have actually been issued by the company to their shareholders. Now, it doesn't mean that everything that is authorized is issued out. Companies may decide to issue out shares at certain kind of intervals, okay? So whatever they have issued out, okay, whatever they have finally issued out is now what is called the issued share capital, okay? So issued share capital basically refers to those shares that have actually been issued by the company to their shareholders. And the shareholders could be, let's say, the general public, the institutional investors, the insiders, and so on, okay? So that is what you should know. And of course, just like the way MTN issued shares, those are like issued shares, okay? The issues, because the shares have been issued out. So when you look at their share structure currently, those are issued out shares. But when you look through their memorandum, you might realize that they might have some other shares that they have held on for not issued, okay? Yeah. So that is something that you need to basically note. And then we now have the what we are calling the bonus issue and rights issue. Bonus issue and rights issue. Now, what is bonus issue basically? Now, from the word, just from the word bonus, okay, from the word bonus, usually these are additional shares that are given to already existing shareholders. Okay, so basically it's more of you buy one share and then you're able to get a bonus to it. Okay, so they are basically free additional shares that are offered to existing shareholders, and that one usually happens where maybe a company may decide that instead of, let's say, distributing more dividends, they can actually distribute shares as an alternative, okay, to the dividends. So basically, that is what you may have to basically say, okay? Yeah. So they are basically just additional shares that are given to shareholders, already existing shareholders, and they may be issued as a result of the company trying to reduce on how much is offered within, let's say, dividends, okay? Yeah, so that is what basically happens with that. And then when it comes to rights issue of shares, now a rights issue of shares, of course, very similar. It's basically an invitation to existing shareholders to purchase additional shares in the company. Okay, it's basically a rights issue is an invitation to existing shareholders to purchase additional new shares in the company. Okay, now with this, you're not looking for new shareholders. Basically, you're basically utilizing your current shareholders, okay, to be able to buy the remaining. Now, for example, like MTN already had existing shareholders, the likes of the MBA and the different other companies that have, let's say, money in MTN. So instead of them calling the public to now buy, like myself and so on, they would have just called on to those people to buy those shares, okay, and say, you already have existing shares, so buy more shares. So that is what would have basically happened. But then they went on ahead to call more people. So that wouldn't be a rights issue, okay? The rights issue means it's only the existing shareholders that have a right to buy the shares that are being issued by the company, okay? So in simple sense, the rights issue is an invitation to existing shareholders to purchase additional shares in the company, okay? And it's more given to existing shareholders. Yeah, even within rights issue, some of these shares might come at a discount compared to the actual market price, okay? It's basically, it's a faster way for companies to raise capital because already they have the shareholders in there. They don't have to, again, have to call out to the public. It's just basically an insider kind of offering, okay? Yeah, that companies can use to basically generate what? Generate additional capital, okay? Yeah. So part of C of this question was saying that the following extract is of a trial balance of JDC Enterprise Limited, which is JDCL as at 31st December 2016. So we have opening balances, we have share capital, we have accumulated losses or profits, then we have redeemable shares, then we have share premium. Now, what I want to basically comment on is Okay, we have what we call, okay, somebody says share other types of shares as well. Okay, we'll be able to share that with you. So what I want to stress here is when it comes to shares, we have what we call ordinary shares, and then we have what we call preference shares. Let me just start from there. Now, what are ordinary shares and what is preference shares? Now, preference shares, from the word preference as it is, these are usually types of shares where the shareholders basically have preferential rights over dividends. Okay, so for them, the most common difference between them and the ordinary shareholders is, for them, even if the company has not made profits, okay, these are usually entitled to a dividend. Okay, these are entitled to a dividend. So you know very well that if it's ordinary share, if you're an ordinary shareholder, let's say in a company like MTN, if MTN does not make a profit, you don't get a dividend, because dividends are paid out of profits. Now, with preference shareholders, like I said, from the word preference, or what some other people may call it, preferred shares, okay, whatever it is, for it, these are usually shareholders that have preferential rights when it comes to the dividends that are paid to them. So before you even invest preference shares in a company, you actually have even a predetermined dividend of how much you'll be paid, okay, on, let's say, on an annual basis, a given amount of money, okay, that you'll be paid. And even when it comes to, let's say, times where the company does not make profits, in most cases, the preference shareholders will always be catered for, okay? So that is one of the things that you need to understand when it comes to preference shareholders. Now, in the same way, we, under preference shareholders, we have what we call redeemable and irredeemable. Redeemable and irredeemable. Now, redeemable preference shareholders, these ones, once they invest money into your company, okay, it means that after a given period of time, let's say after 10 years, they can basically get what? They can basically get back their money, okay, when it comes to the redeemable preference shareholders, they can get back their money, okay? But so you know that if it comes to the ordinary shareholders, if you've invested money in MTN, unless you're selling these shares to another person, you can never get back your money. You can never just wake up and say, guys, give me back my money, because you're part of the owners now. But the guys that have redeemable preference shares, for them, they have a fixed time when their money is within the business, and after some time, they can be paid back, okay? Yeah, then irredeemable. In this case, it's more similar like ordinary shareholders, because you still don't get back your money, but you have the preferential rights, okay? You have the preferential rights that will happen. Now, when they put a 5% here, in most cases, this 5% is the dividend attached. Like we said, that these ones usually have a predetermined dividend, okay? So it means that they have basically a 5% kind of what? A 5% sort of return on these shares, okay? Yeah, share premium already indicated that. Then preference dividends, we have of course, like I said, these ones are paid even if you don't make a profit right there. Then we have interim ordinary dividends that were paid. We have a building cost, we have the bank loan, we have loan interest paid. And then down here, they give us also additional information. So additional information says they're saying the following transactions took place during the year ended 31st December 2016, but have not been incorporated in the trial balance. So they're telling us that an issue of 1,000 redeemable preference shares at par and 2,000 ordinary shares at 12,000 per share. All the shares issued were subscribed for. Okay. And then we have, of course, we know very well right now, if you to follow the news very well, you must be hearing that MTN shares were not fully subscribed for. Okay. So the company can actually issue shares to the public, and they might have either under subscription or over subscription of the shares. Okay. So the subscribed shares are basically those, of course, they basically relate to a portion of the shares that have been paid for, okay, or where investors have committed, okay, to basically do what. And these are usually, this is the idea of subscribed and unsubscribed is usually at the initial public offering, okay, at the initial public offering, just like the way we had with MTN before you listed. At the that initial public offering, that is when we have the subscribed and yeah. And then of course, in the same way, we also have, of course, we have the fully paid for shares, okay? You know, it can be subscribed, but not yet fully paid for. So there are many dynamics of shares that you can try to find out more. Then we have, they're telling us a revaluation of building on 31st December 2016 to shillings 380 million. Now, we know very well that I talked of revaluation, and I said revaluation. A revaluation reserve or revaluation surplus is also a column when it comes to our statement of changes in equity. Okay, so we also have a revaluation right there. So we need to cater for it. And then they're also telling us that during their end, the 31st December 2016, the company realized after-tax profit of 127 million. Okay, 127 million. We know also where this affects. And then they're telling us that a decision to transfer 10 million to a general reserve in preparation of an expansion drive. Like I told you, a reserve is usually money set aside for a certain kind of purpose. Now, in this case, they have a purpose of expansion. Okay. So they're asking us that to prepare for JDECL for their ended 31st December 2016, a statement of changes in equity, and then an extract of a statement of financial position. Now, as you can see, a statement of changes in equity is full in its own. Every time they say an extract, means that you may not have all the information that goes in the statement of financial position, but they just want to see an extract of how the information they have given you would look like within the statement of financial position. So that is what we basically need to do. So I'm going to draw up my my statement of changes in equity. Like I told you, the question determines the columns we have. Okay. So remember how our format here, as you can see, So that is exactly what would also happen of what we are going to basically have here. Okay. So this company is called JDCL. Okay. So we have our statement of change in iniquity for the period ended. For the period ended that. Okay. So I'm going to have the first column. So I'll have the detail, and then we'll have, maybe we'll have, yes, we can have the notes just to show where we should have put our working. And now we're going to start on the different columns that we have at hand. Okay. So I'll just come back to the question and see what columns we need to include. So we'll have a column for ordinary share capital. Okay. Have that column. And then we'll have this column. Now, accumulated loss or profits, the same thing as retained earnings. Okay, so let it not confuse you. It's retained earnings. You know, even the retained earnings can either be accumulated, they can be either looking at losses or profits. So it's the same thing. But I'll just call it the name it has been called here. But so you know that it's also, it will be the same thing. Okay. So then I'll have this column of irredeemable preference shares. Then I have share premium. Okay. Then these ones will follow under. I now have another item here. I have a revaluation account. So I have revaluation surplus. So we have a revaluation surplus. And then the other column that I will have is a general reserve. The general reserve. Let me just try to put that there. So those are the columns we have for now. Okay. So once we have that, now the first thing to do, even when you look at what we have within our format, is to record the balances, the opening balances, the balances at the start of the year. Okay. So I have to record the balances at the start of the year. Now, in this case, I'll say balance as at 1st Jan 2016. Okay, that is the balance. So how I'll get the balance is I'll just come to the information I've been given. Remember they told me that this is the opening balance. So I'll have the share capital is 2 million. Since they are thousands, I'll just put a heading here and say these amounts are in UJEX are thousands. So I'll have ordinary share capital, and here I'll put the 2 million. Okay. And then accumulated loss is 12,000. So I'll just come here and put 12,000. And then irredeemable is this. And then I'll include my 60,000. Right there. So that is what I basically have. And then once I have this, I don't have a balance for basically revaluation. And also here, I didn't have any balance. Okay, these are new accounts that came through during the period. Okay, that is what I basically have. Now, in most cases, after I've written that, the next thing I'll now look at what exactly happened. Okay, so just try to show you. Like you can see, the next thing I'll look at is, let's say, the profit for the year. Okay, I'll look at for the profit of the year, and then we'll be able to see how that moves. So when I come here, preference dividends paid and so on, all this information happened during the, of course, what we have. So I'll just come here and look for my profit. So they're telling me that during their ended, the company realized an after-tax profit of 127 million. Okay, so I'll just go to my question and say profit for the year. Okay, profit for the year, and profit for the year is recorded under accumulated loss or profits. So I'll just say 120,000 because it's 120. It is basically 127 million. So that is what I'll basically record right there, and I'll put it as a positive. Now, in most cases, just so you note also as well, this usually also has a total. Just try to include it here. This usually also has a total. So I'll just first get the total of this first column here. Okay. Now, profit, I only put it under here. In case it was a loss, I would make it a negative. So I'll also just sum it up, and it will give me that value. So here there is nothing at all. Okay. That is what we basically have. So then we have now to look at other things that happened as well. So they are telling us that, let's see. Let's look at this. They're telling us that an issue of 1,000 irredeemable preference shares at par. Now, when they say at par, the par value of our irredeemable preference shares is this 20,000. This is the par value. So if they issued 1,000 at par, it means that for us to get the share capital that comes from these irredeemable preference shares will be 1,000 times 20,000, which is 20 million. Okay. So I'll just come here, okay, and be able to recognize the issue of redeemable. So I'll come and record it under this column. It is equal to 20,000 times 1,000. But since I'm recording these things in 1,000, so I'll just put 20,000. Okay. So there will be nothing, and then this side I'll get my respective value. Then you shall come here. And then they told us that they issued 22,000 shares at 12,000 per share. Ordinary share capital, when you go back and check and see, now, for you to find how much each share capital is, how much each share is for ordinary share capital, you get this 2 million divided by 200. Now, when you get 2 million and divide it by 200, you get to realize that a single share, okay, a single share, because you have to multiply this by for you to come, because this is actually 2 billion because it has these 3 zeros. So basically, a single share is 10,000. When you get this, divide it by this. A single share is 10,000. So if they are telling us that they issued shares at 12,000 per share, means that they issued at a price that is above the nominal value, okay, of the shares, because the nominal value is the 2 million divided, okay, the 2 billion divided by 20,000, which gives you 10,000. So they basically issued shares at a premium. And that means that within this 12,000, there is both the share capital component and then there's also share premium component, okay? So we can just try to do that aside. Maybe we can just have a working. We have share capital. So price per share, like I said, it's basically the 2 billion divided by the 200,000. So this gives me 10,000. So 10,000 is the price per ordinary share capital. So the issue at 12,000 means I'm going to have a share capital component So I'm going to have 12,000. This is equal to 12,000 times. Okay. They issued, let's just try to confirm how many shares they issued. So they're telling us that they issued 2,000 shares, okay? So my share capital will definitely be the shares they issued, 2,000 times what? Times the 10,000, which is my share capital value, okay? Which gives me 20 million. And then I'll have my share premium. Share premium will now be the remainder, it will still be 2,000, okay? That they issued times the 2,000. Now what I'm trying to do is, you see, this has a 10,000, and then it also has the 2,000, okay? So that is what I've separated. The 10,000 is the share capital, ordinary share capital, and 2,000 is the share premium component. So that's why I multiply this by 10, and I've multiplied this 2,000 times the 2,000, so it shouldn't confuse you, okay? So the total amount that we got at the issue is basically 24 million, but this 24 million is broken down into two components, okay? So if I come here, I'll just say maybe issue of ordinary shares at premium, So what I'll do is I'll put the 20 million, I'll put it under share capital. So this will be actually 20,000 now, okay, based on the degree of precision. And then for share premium, I'll put 4,000 there. So under share premium here, I'll put 4,000 as a positive, as we can see there. So I'll just get my total here, right there. So that is what I basically have. And then they have told me that a revaluation of a building on 31st December 2016 to 380 million. Now, when you look at our information given to us at the start of the period, they have told us that the building cost how much? The building cost 300. It cost 320. Okay, that is what we basically have. Now, if they are telling us that it was revalued to 380, basically means that we have to make sure that we get the difference, and that difference will go to our revaluation account. Okay, so 320 and 380 gives you a difference of 60 million. So the 60 million is supposed to be recorded under your revaluation account. Okay, so when you come to here, revaluation, I'll come under revaluation here and put the 60,000. Okay, to recognize the movement from 320 to 380, and it only affects that column. And that's why the examiner gave you this information to do with the building. Just in case there was nothing to do with the building, wouldn't have to put anything. But since we have that, then that is okay. In the same way, this loan, we don't have any information regarding this loan. So this loan will not appear under our statement of changes in equity. Okay, so let's see. And then they have also told us something here. This we have recorded. They have told us that a decision to transfer 10 million to general reserve in preparation of an expansion drive. Now, a movement between that goes to the reserve basically comes from our retained earnings, okay? So we are basically going to move from our retained earnings to the general reserve, a 10 million. So just call it transfer of that to general reserve. So I'll just come here and say transfer of 10 million to general reserve. So what this means is that I'll come here under my retained earnings, or yeah, that's what you may call the accumulated profit or loss, and then come and remove. Shall come and remove 10 million. So here it will be a negative 10 million, negative 10,000. Okay. And then the positive, you come and put it under here. That is what exactly would happen. And then you have your information right there, okay, as given. So that is how we usually make transfers. Okay, we transfer from retained earnings, and then we put it to under what? Under our general reserve. Okay. Sometimes they can just call it reserve, but still similar kind of approach. Okay. Yeah. So that is something that you need to basically do. So somebody says they don't seem to understand revaluation. They don't seem to understand revaluation. So I said, why do we revalue our assets? We revalue our assets when their market value is way different compared to the value we have within our books of accounts. And I say that for this building they gave us that this building was at 320, okay, right here as the information they gave us. And now when you come down, they're telling us that the revaluation on building on 31st December 2016, it was revalued 380. So ideally what that means is that we have to increase the value, okay, to 380. But within the statement of changes in equity, we only record the difference, because in the same way, the accounting entries for revaluation is debit the asset, so we shall debit the building with the 60, so that the building moves from 320 to 380, and then we shall credit our what? Our revaluation surplus account with the difference. Okay, so that is one of the things that you basically need to do, okay, when it comes to that. I would encourage you to look out for, you can try to read more from this text material that I shared with you. There's this text material. This is the ACCA book. The revaluation is on page I think 175. Yeah, could be page 175. Yeah, page 175, you'll be able to find more about revaluation. You can try to read more so that you can basically understand, okay? But like I said, the principle is to do with market value, okay? And I think you can see here they are bringing it, the market value of land. So land and building usually represents a fair value. So you have to basically compare your market value and then compare it with whatever you have within your books. And in case there's a change in the difference, then you have to basically tweet the revaluation, okay? And that is what basically happens. And like you're seeing here, they're telling you that basically the debit will increase the value of the asset in the statement of financial position, but what about the credit? IAS 16 requires us to credit the revaluation surplus, i.e. part of owner's equity. So that is why part of owner's equity, that's why we are including it under what? Under our revaluation surplus, okay? Yeah, so that is what exactly happens. Somebody is trying to ask, what about a devaluation? What about a devaluation? Now, a okay, is it a devaluation? Is it, I don't know how to basically, we have different other terms around this, okay? Depreciation could be very similar. Now, anything like, okay, anything similar like devaluation will be treated just like a depreciation. You'd basically treat it like the way you treat depreciation, okay? But we also have, when you proceed with financial accounting, you study more about things to do with impairment of assets, okay? Where you basically you ideally asked to review the values of your assets routinely and test them for basically impairment, okay? And impairment is also to do with a decline in value compared to what is within the market, okay? So you can try to also do extra study. This handout also has something to do with impairment, which you can try to look through and see how that relates. I may not want to go so much in detail for now. So we have done the transfer of the general reserve, the revaluation of the building. Let's see the other parts that we have. So now we have something here. They are telling us of preference dividends that were paid. Preference dividends, interim ordinary dividends, all these are paid from, they are paid from what? They are paid from your retained earnings. So I'll just pick this and bring it here. 42,000. I'll just come here and put it as a negative. Okay. They are basically a negative. And then the same thing I also do for interim ordinary dividends that were paid. They will also come from the same. As a negative. So that is what we have. I say that we shall leave out this bank loan and loan interest paid. These don't have any effect onto our P&L, okay? Our statement of changes in equity, sorry. They are not basically equity items. So that is all that we had when it comes to the equity items. And if that is all as well from your side, you come and get your total. Your total is right, the last thing down here. Share premium, just a moment. Share premium, we had the beginning figure, which was 60,000 here, and then we had the other share premium came through after the issue of shares. So we catered for it here, okay? So I hope that is what you basically mean. So we already catered for the share premium here. And that is all that we were provided. In case there's anything that you've seen that I don't see, you can basically share with us, unmute and share, or share in the chat box. So I'll just add up. Okay, somebody says we have another figure. Let's just see. Christine, could you unmute and explain what you're saying, if you can? So maybe we can learn together. So we have, I saw share premium here. We're given 60,000, which did we record 60,000? Yes. And then we have this that we picked from here. Okay. So you're saying it's now clear. Okay, that is fine if that's now clear. And then summation of this. Yeah. So basically the total here should also be the total here. Okay. Yeah, this should just be the overall total across of your equity. So this is what we have within our statement of changes in equity. Okay. And then, like I said, the reason why we draw up our statement of changes in equity is when we go to the balance sheet, all we have to now show are the totals. We basically now don't show all the information above, we just show these respective totals, okay? So if the examiner asks you to draw up a because the question was asking us to draw up a statement of financial position extract, they have given it very few marks, but in the same way, those marks are valuable. So I'll just come here, and then this is JDCL. It's an extract of financial position as at 31st December 2016. So basically, you know what goes under what? Under statement of change of statement of financial position. We usually have our assets, and assets we have the non-current assets. So for the non-current assets, we have only one that has been provided. Which one is that? The building. We have a building. So the building was 320, but now 380. So it will now be recorded at its current value. So remember here, still we have things like costs. We have accumulated depreciation. And then we have the net book value. Now for the building, basically they have not given us any other more information around accumulated depreciation. So we shall just write 380,000 because it's 380 million. So net book value right there. That is what we have. I'll move. I don't have any other assets. I also don't have any current assets provided to me. Okay. So I'll just move to equity. Equity and liabilities. Remember, this is an extract, so it doesn't really have to have everything. You just record only what is there, okay? So for equity and liabilities, I'm going to record these items as they are, okay? So I'll just come and put ordinary share capital and put the amount. I'll put it there. Then I'll come to accumulated loss or profit. I'll come and put it here as well. So here I have 57 right there. Then I have irredeemable preference shares. I have 240. So I think you can see I'm only picking the totals, and that's the essence of preparing this document. And then I have share premium. Revaluation surplus. So all these are elements of equity. Sorry, just need to pick the value, which is 60,000. Then we have the general reserve, which is 10,000. So that is what we basically have. Yeah. Even when you get total equity, should be what you have the other side. Gives you that value. And then we have non-current liabilities, because we have a loan that they have given us. So we shall also just try to show it in the extract. That rate remains. So this 24% bank loan, it remains the way it is. The interest will not appear under any. Basically, let's just have this. So this is a 24% bank loan, which is at 80,000. Let's try to find its interest. Maybe we can recognize the unpaid interest. So interest is basically 24%. 24% times the 80,000. So this gives us 19,200, basically 19 million. So what was paid is actually the same. So the interest has been fully paid. So we don't have outstanding interest. In case there was a difference between what we calculate here and this, then we shall just recognize the difference under our current liabilities as interest to be paid. Okay. Yeah. So that is how basically this whole thing would look like. Yeah. The extract, you don't have to even close it off, just an extract in its own. So as simple as that, that is what basically what was required from this question. Okay. Yeah. That is what was required from this question. So any other, I hope that is okay. This is a number we did on cash flows last time. I'll share with you the recording. And then there was a number on inventory. We have done this number before. It's part of our recordings. The extracts are extracts. Basically, it's just an extract. Doesn't have to total up. Doesn't have to balance. Okay. Every time they say extract, They just want you to put the information that is available. They want to see how would that information look like in the balance sheet, okay? Or in the statement of financial position, whatever the question, okay? So that is what exactly happens. Yeah. So that is what I wanted. So okay, good question. Somebody asks. Let's try to see. Okay, somebody has brought something very, very good here, and I think we had missed this. Now, when you look at because this is a trial balance, because they're saying the extract, this is the following is an extract of trial balance of JDC Enterprises Limited as at 31st December. Now, interestingly, the examiner didn't give us a debit and credit. Basically, just give us in terms of thousands, okay? And many people would definitely miss this because of that, and because it's also an extract, like they called it, it's an extract. So I want you to look critically, and this is what somebody has shared with us. So you can see that the opening balance, share capital has a normal credit balance. So that is why we are seeing us having this 2 million here. Now the same thing with also the redeemable shares, sorry. And then we have the share premium with the same thing. Now, somebody says that, isn't this supposed to be a negative? Now, given the information we have here, okay, because this is a trial balance, and on assumption that this is actually a debit side, these are not just values, they're just giving us, if this is a debit side, this would be definitely a negative, okay? This would be definitely negative because it is appearing in the debit side, okay? It's appearing on the debit side. We had missed that. So what you basically need to do, you can come and adjust it here and make this to be a negative, okay? That will just, it will just change that. And then it means that it will change what you had under here. This we had 57, so this should be 33 basically. So I hope everyone understands why we are making that adjustment. It's because of the presentation here. As you can see, they have given us our share capital is on the credit side. Share capital has a normal credit balance. Now, accumulated losses or profits, ideally retained earnings, which is the same word for this, has a normal credit balance. But just like the way we have bank and just like the way we have bank, that bank can have a credit and a debit balance, the same thing with retained earnings. Every time retained earnings are included on the debit side, which the examiner ideally would have put here as a debit to just show you that this is a debit and credit. Every time they are included on the debit side, it's this, they are basically telling you that this is an accumulated loss. It's not an accumulated profit, okay? Basically, they have a loss. So instead of making it a negative on the credit side, they'll just put it on the debit side. That is why we have done this. That's why we have included a negative to have that difference, okay? Yeah. So thank you, Sarah, for picking that up. All right, so that is how the question went. You can try it out and see what comes out, but I believe you might have, you at least have an idea of how this looks like, just in case it comes in the exam. Okay, so unless there's another question, I would like to close this class.